All right, folks, joining me now, Manulife Investment Management Global Chief Economist and Strategist, Francis Donald. Francis, we're lucky to have you on a day like today. First, just your thoughts, your overall thoughts on this CPI report.
Uncomfortably firm was the word that we used. And when we talked to our portfolio managers about it, we said, look, heading into this number, we've said it repeatedly. We have a market that's very comfortably priced, a soft landing, slowdown in inflation, and an easing cycle. That's a very thin tightrope, Charles, to watch. That's all the good news currently priced in this market. And there's a lot of risks. One of the risks is that growth disappoints. Another one is that inflation just comes in a little uncomfortably high. Or here's a risk that maybe we think is a good thing, but it's a bad thing. Growth actually reaccelerates, and then you've got to take out all of those hikes. I don't think risk would like that either. So heading into numbers like this, what we see is that a good news is in the market already, and there are a lot of challenges that we may run up against, and some of them look good on the surface, but will be problematic for risk.
So let me delve in there a little bit because I get a chance to interview some really brilliant people every day, and one thing that it's interesting is talk about having your cake and eat it too. So on one hand, they're saying inflation is coming down. It's a non-event. It will be gone. But wages are going up. The stock market's at an all-time high. Home prices are holding up. And I'm saying, well, if we have this sort of wealth effect on one hand, isn't that the genesis of the Fed's issue? Isn't that where it all begins, when people feel so like they're so flush that they're going to go out and spend? I mean, how do you get inflation down with that same backdrop?
That's the discussion my team and I were having this morning is, well, wait a second, if we're wrong, because we do still have a recession call, even though I don't think it matters as much as many people believe. But if we're wrong and growth actually holds in, there is no rise in the unemployment rate, we still have a 3 handle on inflation. Why would the Fed cut? And even more importantly, if they do cut, isn't that just going to reinvigorate inflation more? So we've actually been saying, look, a little short recession, a recession net, maybe we'll call it, is not the worst thing to happen to most investors' portfolios. It would be short-term pain for long-term gain. What really concerns me as a bigger risk for most markets, most investors, is actually the economy does too well. We get stuck in higher for longer, and those rates create either a higher risk of a financial accident or actually more pain in 2025 than something shorter in 2024.
I saw the Bank of America, their monthly survey and of fund managers, and I think this sort of hard landing is down to 1 out of 10, to your point. There are very few people in that camp anymore. Not long ago, everyone was in that camp. You've always been sort of consistent there. So what is it now we're looking for as investors? Let's switch a little bit from the economist hat to the strategist hat. Obviously, all the major indices are down. Small caps are getting absolutely annihilated. There was some nibbling there in the last couple of weeks. I know the maturity wall is back in play. How do you invest in this sort of environment now?
Yeah, humbly is one way, Charles. And I think with limited conviction, there are times for big bets, and there are times to be aware that if we are at an inflection point, it's now. So I often say, I am an economist and a strategist. Sometimes they're the same job. Sometimes they're totally different jobs. For the past 6 months, we've still had this recession call, but you and I have talked about, hey, that recession's not going to get priced into the market. The Fed's going to pivot. Enjoy your pivot party while it lasts. That tactical Goldilocks story that has been so supportive of risk markets starting in about November, December, where we could say, hey, we're going to get our cake and eat it too. We actually see a lot of risk that that's going to diminish in the next couple of months. And as I mentioned, that can come from a few different places. It can come from the market pulling out rate cuts, which is what's happening today, or it can come from growth disappointing. And right now, what we think is that inflation is going to be a little uncomfortably hot. Those rate cuts are going to get taken out. And then that's going to be problematic for both fixed income and equities. Later this year, we see growth disappointing, and you're going to see those rates come down. You're going to be able to pivot back into the fixed income part of your portfolio. This is a very tactical market, Charles, not the time for big bets. I'm not doing it myself. We're not doing it in the portfolios. We're not telling clients to do that either.
All right. I think the right word you hit on was let's all be a little bit humble right now and just kind of let this play out. Hey, we're lucky to have you today, Francis. Thank you very much. Appreciate it.
Thanks for having me.